Today.
Awesome. Well, it's
Good.
7. Thank you for everyone joining us, EC Head Consulting, for our Wednesday evening Notary Nuggets. We have Ronald Matlock back in the house for part 2. Okay. Welcome again, and take it away.
Thank you so much. Thank you so much for you all allowing me to come back again. I had so much fun with you all last time. I definitely had to come back again. I was really impressed by everybody's excitement and just thoughts and knowledge and willingness to have an open mind. So thank you all for inviting me back again. I'm going to go through some things. I really hope people were able to get inside their books, read a few of the concepts because I'm going to be going over a lot of those concepts today. I'm going to be going over the overview of them, but as you get into that book, you'll be able to learn more. Okay. Well, once again, I'm Ronald Madlock with MT Financial, and I would like to talk to you today about infinite banking. So I'm going to start off this presentation by doing a little refresher, right? It's been a while since we had the last presentation. Let's just cover some of the key concepts that we were able to cover last time. Okay, the problem. The problem is that everything that we buy, we finance, and we do not know it, and we do not benefit from those things being financed. Whether you're buying something at an interest rate or you're paying cash for something and you're giving up your ability to earn money on that money that you paid, meaning that we finance everything. And the problem is that other organizations are benefiting from it, most namely the bank. What is an infinite banking account? An infinite banking account is created through a high cash value, whole life dividend producing policy. And an infinite banking policy is not an investment, it is more like a high interest savings account. I cannot stress that enough. This is the foundation of your banking system for you and your family. This is not something like it's a ETF or a stock or a bond or anything like that, where you're just like, okay, are the interest rates going up or down and things like that. I just want us to compare apples to apples. Now, why do we use this? Because when we work with insurance companies, we have so many guarantees, so many benefits to working with them, is that we have a consistent rate of return, tax free growth, tax free distribution. We have easy access to our cash, and we have guaranteed values. And my favorite part is we have complete control. We decide what we want to do and when we want to do it. And that is not the truth with a lot of other products out there that we are marketed. We don't have control. The only control we have is how much we're putting in it. And then it goes off into some fairy tale land until somebody tells us how much it's worth again. Infinite banking is a process, not a product. Again, infinite banking is a process, not a product. Sort of like we went through this process, the banking process. Right. So with the infinite banking account, the premiums go in, loans come out. You repay those loans, you loan that money out again. You repay those loans, you loan it out again. You pay those loans, loans it out again. And it all adds to your pool of money, helps increase it. That is the same process any bank that you go to. I don't care if it's Chase, Wells Fargo, Navy Federal, the process is the same. They make money by keeping money in motion. But it first starts with putting the money in, making those deposits. And the part of this process that we forget about is that we are the ones making the deposits, but they're the ones making all the profit. We want to change that. We want you to be the ones making the profit. So, this book is the Infinite Banker Handbook. This book, Become Your Own Banker by R. Nelson Nash, this is the book that I mentioned in my email, my follow-up email to everybody that registered for the last um, webinar. This book will take you through the thought process of somebody that's going to be a responsible banker. Now, this book is less than 100 pages long. I think it might be at the longest 93 pages, and that's including, you know, some of the cover pages. But is built around the idea of just this concept could be like a 10-hour course because it's such an important concept, and it has working parts to it that people just need to open up to. Now when you get inside this book, which I'm sure everybody on this call was able to do, when you get inside this book, you'll run into a few concepts, and those concepts are the things that I wanted to go over this evening. Okay, well, first, people always want to know, where did this concept come from? And this is this gentleman right here. This is R. Nelson Nash. This is the guy that wrote the book. This is the guy that invented the process of infinite banking. Now, a little bit about R. Nelson Nash. R. Nelson Nash received a degree in forestry, right? And over his time, a person in forestry, they're planting and planting forests and things like that. That was his job, right? He wasn't a mathematician. This guy did not work on Wall Street. He didn't go to Dartmouth. Now, he was a regular guy. He worked in forestry. Throughout his time in forestry, he started to get into real estate investing. And then throughout that process, he started to become an insurance agent. Now, all three of those career areas for him allowed him to put together this process. Why? Through forestry, what did he learn? You can make deposits today, right? Investments today. Now, you won't immediately see the benefits, but give it time. And then it starts taking care of itself. Just like in the forest, you start planting a tree, you're not going to see that tree for some years. But after time, that tree is going to grow and grow and grow, and it's going to produce even more things. It's going to produce shade. It's going to produce habitat for animals, right? It's going to produce dividends for you, right? You think about that as the concept of compound interest. You putting in something today and you're consistently doing it over time, and it's going to grow and it's going to start growing on its own. All right. He started working into real estate investing. And what did he learn? What a lot of people learn in real estate investing, people, always want to say, use other people's money, right? That's the key to making a higher return, using other people's money. But what he learned is, through a lot of different interest debacles, is that is all contingent upon the interest that you're paying, right? A 1% change in the interest that you're paying can turn an investment from profitable to a loser. All right. And through insurance, what did he learn through that? He learned that insurance policies offered so many guaranteed benefits. And if you can just tap into those benefits, you'll be able to create a structure that will create wealth. All right, so now I'm going to go over some of the concepts that you'll find in the book, right? The importance of imagination. It is more important than knowledge. Why do I say that? This whole concept of using a traditional policy, or a whole life policy, something that people have a traditional mindset about, and say, you know what, we're going to take that old thing, we're going to dust it off, and we're going to turn it into something new, right? And we're going to make it work for us and make it applicable for us in this day and age. I mean, how many times have you had a great idea? How many times did you want to do something? And people talk about this. A lot of different entrepreneurs, they go, how did you come up with this? Why did you start doing this? And their answer is usually, well, I didn't know I couldn't do it, so I did it. You know, sometimes we have these great ideas and it might sound weird to somebody, it might sound unconventional. But I mean, if you look around, we're doing unconventional things. Think about what we're doing right now. We're literally having a meeting over a computer, right? That's in everybody's home. Years ago, people only thought that the government or companies will only be, have enough money to uh, afford a computer. A computer in your house, those computers were as big as houses. Now we have something as small as our phone that's more powerful than those computers. We're doing amazing things every day. But I bet there were naysayers, there were people that could not use their imagination to say, this is possible. So think of infinite banking in that realm. It's not something that a lot of people are going to understand. It's not something that a lot of people are going to get on board with. But you have to be comfortable with that. Sometimes we get uncomfortable about being out front. We rather walk with the pack. I just say it makes you easier for slaughter. I don't know. But if you're out front, you can see what's coming first. But I digress. There's a capitalization phase. All banks need deposits. This was something that I mentioned at the beginning of the presentation. This is also something that we went over in the last presentation. All banks need deposits. Where does your bank get the deposits from? Where do they get the money to loan you back from? Where do they get the financial backing to be able to issue you a credit card from? They get that from you. So if you're starting your own bank, what do you think they're going to need? Deposits. Your bank is going to need deposits, just like that corporate bank needs deposits. And also, compound interest builds over time. Now, the way we set up policy is that you're going to see a cash value year one, but it's not going to be as high as a cash value you see year 10 or 20 or 15, because it takes that momentum. Just like a tree, when you plant a baby tree, it's not going to be a redwood overnight. It's going to take time, but once it starts growing and once it starts going, it's going to pick up pace, momentum. It's going to be absolutely unstoppable. So, as I know you all read in your book, there's a grocery store example. You like that?
Yeah.
Oh, okay. So there's a grocery store example, right? There's a grocery store example, and the big headline with that is "Do not steal the peas." Let me refresh you, right? Because I know it's been a while. I sent it over a month ago, so I know you guys need a little refresher. So let me refresh your memory, right? So basically, let's say your family starts a business, right? You start a grocery store. I mean, what's going to happen? You want your family to come there, you want your friends to come there, but you're running a business now. But you know what? Let's say your husband, wife, significant other, they come in, like, you know what? We need some food at the house. I'm gonna grab some can of beans, grabbing some black eyed peas, and instead of going out the front door toward the cashier, they go out the back door and put it in their trunk.
It'd be your own family.
And then sometimes it's you. And that is the issue. And that is the issue. Why? If you don't treat your business like a business, nobody else will, number one. Because if your employees see your significant other walking out the back, they're like, well, I guess we all family. We all family in some way. So now they're taking merchandise out of the store. Now you're not being profitable, right? The value of learning how to get into business in which you are a consumer of the same thing that you sell, right? You want to be able to give yourself loans as well as develop your cash value as such that you can loan it out to other people, right? But if people know that when you're taking loans out for yourself, you're not paying yourself interest or you're not paying yourself back, especially if it's a family member, because you know you didn't told them about it. So now you loan them some money. You might have it down in a contract, you have it all professional. But if they don't see you practicing what you preach, they're less likely to pay you back. Don't steal the peas. Walk them down to the front aisle, just like everybody else. Walk them through because it is a process and it takes discipline in this process. And I had a conversation with somebody. I said it's more difficult to take care of yourself,
Mhm.
to be responsible for yourself, right? You think about many of you all are entrepreneurs on this call. You have to make a lot of different decisions that would be a lot easier if you had W-2 money and you knew how much you were bringing in. But when you're an entrepreneur, that extra $100 or $50 or $20 can make you or break you, right? So not being responsible with that money could hurt your business in the long run. That's the difference between being short-sighted, wanting instant gratification, and being able to plan for the future, right? So you want your business, you want your grocery store to be successful. I want any type of business you have to be successful, and I want your infinite banking structure to be successful. You have to be disciplined. The money problem. Well, as we know, as I spoke about W-2 money, we can only spend the money that the taxes didn't take out before before we even receive the money, right? Then that's less, right? And then you spend most of your money on, housing, cars, and all these other things, and then it's gone. It's gone out of your system, like we spoke before. Even when you're like, you know what, I don't want to pay any interest. I'm going to save up all of this money and I'm going to buy this $30,000 car. But once you buy that $30,000 car, all that money is gone from your system. But if you put it in your infinite banking system first, you can recover it like we did last time. Over a 5-year period, we pay ourselves back. We pay ourselves back with interest. You not only have the car after those 5 years, but you have the interest that you paid and your principal back ready to do it again. So now I just want to go through some frequently asked questions. How much can I put in my policy? You can put in your policy as much as the insurance company is going to allow for you to put in there, right? And that all depends on a number of medical questions, age questions, salary questions, and things like that. But the short answer is you can put in there as much as you would like according to their guidelines, and they'll let you know as the process starts. Next question. Can I start a policy for a child? Absolutely. As soon as that child is able to have their own social security number, they can have their own policy. I will say this, the caveat with that is the amount you're able to get on your child is going to depend on how much coverage you have on yourself. So don't say, you know what? Because it's going to be less expensive if you get it on a child. But some people want to be slick. Well, I get $1 million out on the baby. They're like, come on, justify that. Okay, how much do you have? Right? You can't have 100,000 coverage on yourself and $1 million on the baby. So what insurance companies usually do is they say, how much total are you covered for? Okay, let's say $1 million. Well, your child can be covered to up to half of that, right? For up to half of that. So your child can have a policy for up to $500,000. And again, these are whole life products. So that means that the price that you lock in when they're 30 days, 40 days old is what they'll be paying for the rest of their lives for that type of coverage. Am I too old? I'm not going to touch that, but I'll say I'll let the insurance company determine that. I'm not going to say that you are. I'm not going to say that you aren't. I'm going to say, let's let the insurance company decide that. Don't count yourself out. Don't count yourself out. Let them tell you no, and let them tell you why, and let them and see if there's something you can do to maneuver around that. Sometimes it's possible. How soon can I borrow from my policy? When you start a policy, uh, within about 2 weeks to 30 days, you can start borrowing out your cash value. All right. When do I have to pay my loans back? That's a great question. And I'll tell you a simple answer. That's going to scare you. That is entirely up to you. That is entirely up to you. At this current time, the interest rate that insurance companies are charging you for borrowing against your cash value is like 5%. So if let's say you want to take out $1,000, right? 5% of $1,000 is $50, right? Check my math on that. $50, you're gonna give me a thumbs up. 5%. Uh-oh, that was an unsure thumb. All right, but it's $50.
Well, I'm the only one that with their camera on,
so. But $50. So what'll happen is
excuse me,
yes, ma'am.
Mr. Ronald. Miss Mika, my camera is on. Thank you. Very much.
I'm so sorry.
I see it with her beautiful natural hair.
Thank you.
You're welcome. But so $50. So what happened is, okay, you took the $1,000, which they'll send to you. If you want it in check, they can give it to you in check. If you want a direct deposit to your account, they can do that as well. So they'll send that $1,000 to your account. They'll say, all right, Ronald, we sent you the $1,000. Just understand that we're going to charge you 5% on that for the year. So next year, at the time where you're going to pay your premium again, pay us $50. That's it. And people want to ask, okay, what if I keep that $1,000 out another year? Well, the next time you go to pay your premium, they're going to say, hey, I need $50 worth of interest. So you get to control that $1,000 for $50 a year. Again, it's up to you when you pay the principal back. But as you know, kind of like with a line of credit, when you pay it back, that balance goes down. So does the interest that you're going to owe on it. That's going to go down as well. Okay. Does anybody have any questions about that? No. You good? Okay. What happens if I die with outstanding loans? What happens is this. So let's go back to
try and get it.
So if you have some outstanding loans from your policy, what'll happen is this. Let's go back to the $1,000 example. Let's say I have a death benefit of $100,000 and I have an outstanding loan of $1,000. What'll happen is this. The insurance company look at your account. They're going to say, oh, I'm sorry for your loss. Then they're going to go, okay, he has a loan balance out of $1,000. He's covered for $100,000. Let's just subtract that $1,000 from the $100,000 that we're due to his family, and now they're going to get $99,000. That's what happened. So whatever you owe, they'll subtract that from whatever the death benefit is, and then they'll just give it. They'll give the rest of it to whoever your beneficiaries are. So I have a lot of people asking me, do I get the cash value and the death benefit? When I die, I'm like, no, you don't. You get the death benefit, which is going going to be more than what you put in anyway. So it's all right. Any questions on that? No, we're good. Okay. What is the process of requesting a loan? All right. Great question, Tamika. So when you requesting a loan, what happened is you'll call me up or call up somebody from my office. You're like, hey, what do I need to do? And usually it's a piece of paper about 1 to 2 pages long. You'll say, hey, this is my account number. This is how much I want to borrow from that account. And I'm going to sign it. And I'm going to let them know, do I want it in check? Do I want it in direct deposit? And that is the process. You turn that in. If you have that cash value available in your account, that money will be in your account for, like I said, in like 3 to 5 business days. Do the loans affect my credit? No. That's one of the great things about it. They don't pull your credit. This is not a bank. They're not going to pull your credit because they're using your cash value as collateral. Like they already have it. You know, they're just letting you borrow money that they know that you already have. It's no problem. No, you don't have to, sign an application or anything like that. They're not, like I said, they're not pulling your credit. They don't need your social security number and all that type of stuff. They're not collecting 2 years worth of tax returns or last 30 days of pay stubs or anything like that. Can I get policies on other people? Absolutely. You could get policies on spouses. You can get policy on children, other family members that, you might be responsible for. Like, hey, I know that I'm going to have to take care of my mom or take care of her affairs or my father's affairs or uncles or however the situation plays out. I have to take care of their affairs. Then you have like a financial interest in that person because you're going to have to take care of their affairs if something happens. You can get it on those people as well. Business owners.
Let me ask you a question about that. If
yes, ma'am.
Someone, let's say Tamika wanted to take a policy on me,
yes,
because when I get older, she might have to take care of me. Mm-hmm. But do I have to sign that policy?
Yes, you have to be made aware of it. Yes, ma'am. But you know what? In that
I just don't want her running out getting a whole bunch of money on me, so she cash out when I die.
Wow.
But of course you do. You should. You want her to be good when you're gone so she can take care of your affairs.
Oh, that's right. That's right.
Her next generation to be on a higher plane. I got you, Tamika. Don't worry about it.
I was thinking I was going to have to pay that premium. No, but she would be paying it. That's okay, correct. Because you can go get some insurance on me.
and I'll make it even easier than that. If you're like, fine, I want to get this policy. If you and Tamika are talking, you're like, hey, mom, I want to see if I can get 100 or 200,000 on you. Just so if anything happens, I know that you're covered. I know any of your affairs, any assets you have that we'll be able to keep. We'll be able to keep the house, if I get this on you. You say, you know what I'll do is, and this is the easiest way to do it. What you can do is you can get the policy out on yourself and you can just put her down as the payer. Because it's easier to do it that way, because if Tamika tries to do it, then you have to be involved. I gotta sign and stuff, and they're like, "Oh, so why you want to get it?" It's a lot of extra questions that way. But
I'm okay with that. She can get it. I'll answer the questions.
Yes. Okay. Well, either way is good. Or like I said, you can just get it out on yourself, and you just make her the payer, and she'll be able to pay it no problem, and she'll still be the beneficiary as well.
I'm gonna let her take care of that.
Yes, ma'am. Yes, ma'am.
I don't want her to even think about saying, Mama, can you pay it this month? Jeanette know what I'm talking about.
Anything else? Any more questions, Ms. Liz?
No, sir.
You sure? Okay. I'm here for you. I'm here for you.
I just wanted to be straight.
Absolutely. And again, with you all being business owners, two things. One, your business can own a policy on you. And if you have partners in that business, you can have a policy, on your partner. Why? You have a financial interest in that person. You guys have a business together, right? They have value to your business. So if something happens to them, you need to be able to replace them. So you can buy policies out on them, even some of your workers, or employees, excuse me. So some of those employees have very important positions and they perform very important functions. So you're like, man, if this person died, I would need to replace them. And my bottom line will be affected because of it. You can get an insurance policy out on them. Okay. Any questions?
No,
Any
sir.
questions about anything? Okay. Well, what I had here is, can you all see this?
Yes.
This
Yes.
is a policy that I wrote on somebody recently. So this is just an example. This is a person that wants to have a $20,000 premium, right? Can you all see my cursor?
Yes.
Yes, very well.
This is the heading that says guaranteed. I really like that section that says guaranteed. And it's mainly because it's guaranteed. Everything underneath here that says guaranteed, I will have. And if I do not have it, there's a problem. So as you can see, you can look at year one. This gentleman is 48, right? This gentleman is 48. So his first year, he's going to put in a premium of $20,000. As soon as he pays that payment of $20,000, he's going to have $10,000 available to use for whatever he wants to use for. And as you see, the cash value keeps growing every year, as you see in this fourth year, because the first 3 years are the most expensive parts of the policy. That's when you're going to pay the most fees and all those type of things. But as you can see in year 4, ma'am, as you can
Mother,
see,
put your mic off.
no problem. So as you can see, year 4,
Busted.
as you can see, year 4, this person puts in 20, his cash value grows by 19,000. Right?
Ronald, why did you pick such a high premium? We need to see somebody that put in 5,000. What is this?
Somebody that puts in 5,000? It all varies, right? It all varies. I just want to give you an example, a recent example.
We're entrepreneurs.
I understand, but that is the point. Like, it's going to be a struggle those first 3 years, but as I'm going through, and that's why I'm going through the illustration, because as you can see, when he puts in this 20 year 4, he gets 19 in his cash value, right?
Mm-hmm.
Now you start looking at year 5, then we're even closer to that 20. That $20,000 that he put in is going in here. So when he's going in from, when he's going in from year 5 to 6, he's putting in 14,000, and his cash value, his guaranteed cash value, grew by 14,500. That's my point. As we were talking about that tree, it's going to start off small, but it starts gaining that momentum. As the money starts compounding and things like that, you start seeing the more. Yes, ma'am.
Because it's long term.
Yes, ma'am.
This is the long game, not the short game.
Yes, ma'am. Absolutely. So again, by the time you get to year 5 and 6 here, his cash value is growing by everything he put in. It's like you go into the dollar store and say, okay, I have 10 things for $1. Cool. Here's $10. When I come back tomorrow, I want to be able to use that same $10 I just gave you. And this is exactly what it allows you to do. Again, so now I'm going from year 10 to year 11. So in year 11, he's putting in 11,000, but his cash value grew by 14. So now his cash value is growing by an additional 3,000, more than what he put in. Compound interest, and it takes that time. And why did I start off with a higher number? Because it's just like with anything, any type of momentum. It's that compound is higher when you can put in a lot more in the beginning. So yes, absolutely. You can see here by the time he's 68, what did he put in? Put in 11,000, still getting $14,000 a year. So he's getting an extra 3,000. He's making an extra $3,000 a year just by paying $11,000. So I'm gonna just take you over to this side that says non-guaranteed, right? On the non-guaranteed side, I'll take you over to the cash value, which is perceived at that time to be $373,000. I don't usually go on that side, and I don't harp on that side. Most other people do, but I'm like, it's non-guaranteed. We're about guarantees over here, right? But on the non-guaranteed side, to me, it looks like from year 19 to year 20, if in the non-guarantee includes dividends. Dividends are not guaranteed, but again, the company that I work with has been paying dividends for the last 100 years, right? For the last 100 years. So if everything is going the way it was going at the time of this illustration, instead of it growing by this amount from year 19 to year 20, this grew $24,000. So if everything goes perfectly, he put in 11,000 and it grew by 13,000. He had an additional 13,000 that he put in. And if you keep looking over to the right, the death benefit grew as well. Because when he started, it was almost 500,000. Now it's almost 900,000. And even on the guarantee side, it grew from 500,000 to almost 800,000. This is how this thing is powerful. And I stair-stepped it. You see how I stair-stepped it down.
Right.
I decreased the amount that he was paying. But again, the momentum has started in those first 5 years. The momentum has started. So he already worked up enough momentum that when we start getting into year 6, 7, 8, he's already on par and a little above what he's putting in. Why do I do it like this? Why do I stair step them? Because maybe over time, a lot of people, when they get their first policy, they're like, okay, I'm just going to try this. But once they start using it and they see the benefit of it, that, when you put the money in, you could definitely take the money out, and they have a system down, then they're like, you know what? After this year 5 and 6, I want to start another policy. So I usually stair step it like this. But the beautiful thing is, this 20,000, he can keep putting in. He can keep putting in if he wants, but he only has to put in that 14,000 that we have here on the illustration. So, questions, comments, concerns? No questions? Nothing?
No, sir.
You sure?
I'm sure.
5,000. Okay, 5,000. But I recently ran something on 5,000, and it's something similar, but it's just with smaller numbers.
Right.
And the big difference is that if you buy that $5,000 policy, which is fine, if that's what you can afford, do what you can do, because the most important part is that you start. Because the clock on compound interest and momentum does not begin until you start, period. So like I said, again, even with that $5,000 policy, in year 6, I'm still going to step it down. So maybe in 5 years, things have changed for you in the finance department, and you can do more then. So you're like, shoot, this was working for me when I was only using 5,000. So I can step it up. I can do a lot more things like that. So, you know, I would not discourage it, because I encourage people just to start, get into that book, and start. Because once you start and you start using it, you start testing out the system, especially as entrepreneurs, because this is how I look at it. I'm securing my legacy before I build it. I'm securing my legacy before I build it. I might have $1 million dreams. I haven't made that $1 million yet, but in the process of building and getting that $1 million, if something happens to me, my family still gets it, whether I built it or not. I bought it already. I bought their fortune. So, but thank you all so much. This is me again, Ronald Madlock at Infi Financial. This is my email address, phone number. I just finished my website. Please visit my website and give me feedback. I really appreciate it. I'd really appreciate your feedback on it. And if I could ever be of any assistance, answer any questions, I would love for you all to email me any questions that you have. I'll get back with you. And what I'll do is I'm available. I've been giving consultations, but if you want that consultation, please email me on that email address. I'll send you a link to set up a consultation, a 30-minute consultation with me, and I can walk through something more personal for you. Because a lot of people have different goals, right? Because somebody might look at this policy, for instance, and say, you know what? I'm just going to let this grow until I'm 68. And then I'm going to start pulling $20,000, $30,000 out a year as a pseudo retirement for myself. You're like, man, you looking at 300,000. You're like, man, it's only gonna last maybe like 10 years. It's not true. Why? Because if he starts back putting in $20,000, look at year.
Chris, tomorrow we're gonna call the nurse. After tomorrow, the nurse is gonna have to pass you your meds. Okay, like I told you.
Oh, no, thank you.
Sorry about
that. No, thank you. I'm good. No, you're fine. No, thank you. I'm good. I'm trying to avoid that. So,
I was just clicking a little bit. I won't call it that. Who's that, Sabrina? Yeah.
So again, so at this time you're growing by 14,000. If you jump it back up to 20, if we do 20 all the way down, again, you'll be getting to the point where as you put in money, you have even more money in the coffers for you to use the next year and the next year and the next year. So you'll have more than 10 years. So again, it depends on all what you want. Or you say, hey, I'm 50, my baby about to get married in 5 years. You know, I want to be able to get a policy on her and have some cash value so I can pay for the wedding. Then I can give them a down payment for their house, right? People do that. So the possibilities are endless. That's why you need imagination when infinite banking. So thank you all.
Question, Mr.
Yes,
Madlock.
yes, Miss Madlock Dent.
What if the person doesn't want a policy or anything like that? They just want to earn money. You know, how can we earn money doing what you do?
Yes, Jeanette. I love that segue, Miss Jeanette.
I love that. Okay, Miss Jeanette. Again, okay, some people say, look, I don't want a policy. And some people say, you know what, I don't even want to build the policies. But I know people. I know people that would love this. I know people that I could bring to you. What you can do is this. You can get in contact with me on my email address, and I will let you know the processes you need to go through in order to become a licensed life insurance agent. It's only because there's a rule in life insurance that you cannot pay commissions to somebody that.
Yeah, I'm sorry, I gotta take this call. Sorry.
No, you didn't.
You know what? She asked that question for us. That's okay.
Oh, that's fine. That's no problem. So again, so you have to get a life insurance policy. Excuse me, a life insurance license, and then I could pay you a commission per policy of somebody that you brought to me. And that'd be at a rate of like what, 25%. You get 25% of whatever commission I get.
Nice.
You said
So
25%?
yes, ma'am.
Awesome. That was your brother. He was calling for the link. Got you.
I understand. Thank you.
He was calling to help you make some money.
He was calling at 7:45 for the link.
He just got off work.
So, but yeah, and you know what? It took me a week to study for it. It really only took me 3 days. The reason why it took me a week is because they only offer the test on certain days.
Okay.
Right. So, but it's really, really hard. I mean, if you study, you put in a few hours a day for 3 to 4 days, and you use this system that I use. It's a great company, and you keep doing those practice questions and tests. I literally saw some of the same questions on the licensure exam. So,
are you going to form a study group?
It's online, and
Right.
it's go at your own pace.
So no.
In other words, no.
Go at your own pace. You know, let your motivation fuel you.
I like that.
I'm like Jeanette. I got to take this call.
Oh my goodness, they are off the chain this evening. Ronald, I apologize. I apologize.
No, it's a problem. It was too tame tonight. I was getting beat up last time. I was loving that. So they was way too tame tonight. But no, I appreciate it. And again, I'm willing to speak to people, do consultations. If we want to do another something down the road, let's do it.
Awesome.
I mean, if we could talk about, really, we could talk about how we can mix this with our business and real estate and all that other type of stuff. Oh man, I love to get into something like that. Whenever you all have time, or I can partner with somebody else that has something, let's do it.
All right. Well, thank you. Thank you again for coming on and giving us a part 2. Even though you was throwing a little shade about that book, I will say that I did download it. Okay. And my intentions were to read it, and then life happened. Okay. But I will read it. I already downloaded. So I will read it, and then I'll be able to better understand that. Well, I mean, I still understood Don't Steal the Peas, but yes, I will read the book.
I look forward to it. Please, I look forward to that conversation. I look forward to that progression in your thought. I love it. Please call me.
I will. All right.
Again, focus on the small number to get to the bigger number.
Oh yeah. You know what? I've been trying. My heart is not to mute everybody when they come in here, but I see that's what we're gonna have to do, because it's a year in and we still have this problem, and it's very frustrating. So anyway, we try to have it, so people can just talk freely when they feel like it, but let's be respectful. So anyway, I'm gonna get off my soapbox. Thank everyone for joining us. Yeah, right. Thank you
for part 2. Thanks for the part 2.
Yeah, thank you all.
Yes, thank you for the part 2. It looks like we might need a part 3 as well. So I will be in contact with you. Again, thanks for everyone that had joined us. This will be on our Facebook page as well as our YouTube channel. Our YouTube channel has hit 1,000 subscribers. Woo! So,
congratulations.
Yeah, thank you so much. Thank you so much. So just keep that in mind for the people that are listening or that are watching. If you want to present, your small business on this platform, please contact me. We get a lot of people watching it, and it's like, wow. My son was so surprised when I opened it up. I guess about like 3 months ago, we were at 700, and he was like, y'all got 700 subscribers? Like, he was doubting my skills. And I was like, we talk about some good stuff. So if anyone is interested, please hit me up. We are not having Jeanette, keep them coming. You send me a lot of people, and I thank you for that.
No
we
problem.
are not having classes on this Saturday because we did have a death in the family. We will pick it back up on Wednesday of next week with Notary 101. All of our classes are on our website, so please feel free to look at that. Also, we have a great March coming. We have lots of good people in March, so please check our Eventbrite and sign up for all of those coming in. And guess what, Ronald, you finished early. It's 7:50.
Good job.
Awesome.
I'm trying to be respectful of your time.
Well, you know, you got a whole hour, but I appreciate it because I had put some dinner in. Jeanette interrupted me while I was cooking dinner, talking about she need the link. And I've been trying to text one of my kids to come downstairs and check it. Ain't nobody responded to these text messages. So I'm glad you give me extra 10 minutes to go get my food out the oven.
Love it.
Thank you, guys.
All right.
Appreciate it.
So
Need a
thank
plate.
you. Good night. Good night,
Bye,
everyone.
everybody.
And we'll see you next Wednesday.
All right.
Thank you.
Blessings
Bye-bye.
to the family. Blessings
Bye.
to the family.
Thank you.
Condolences.